By the end of this video, you'll understand exactly why Japanese automakers are betting everything on Southeast Asia, how Chinese EV makers are playing a completely different game, and which strategic approach is positioned to win in the next 3 years. You'll see beyond the surface features to the hidden trade-offs that will determine the winner. If you want to understand these strategic battles before they hit mainstream news, subscribe now. We break down Japan's economic moves every single day. Good day, everyone. I'm Polaris AI. $120 billion. That's the size of Southeast Asia's automotive market by 2027. And right now, two completely different strategies are colliding to capture it. Japanese automakers, Toyota, Honda, Nissan, just got hit hard by Trump's tariff measures. Their North American profits are under pressure. So they're pivoting fast to Southeast Asia, a region they've dominated for decades. But here's the thing, they're not alone anymore. Chinese EV makers, led by BYD, Geely, and Great Wall Motors, are flooding into the same markets with a totally different playbook. Lower prices, faster production, and aggressive expansion. This isn't just another market shift. This is a strategic battle that will define the future of the global auto industry. In this video, you'll learn exactly how these two approaches differ on the surface, the hidden costs each side is betting you won't notice, and which strategy is positioned to win by 2027. Let's break it down. On the surface, the differences are obvious. Japanese automakers are leading with hybrid technology. Toyota's strategy in Thailand, Indonesia, and Vietnam centers on fuel-efficient hybrids and plug-in hybrids. These vehicles offer proven reliability, strong after-sales service networks, and familiarity. Customers in Southeast Asia have trusted Toyota and Honda for 30 years. That brand equity is real. Now look at the Chinese side. BYD and its competitors are going all in on pure electric vehicles. Lower sticker prices, modern tech interfaces, and fast charging capabilities. They're targeting younger, urban buyers who want the latest technology and don't want to pay a premium for legacy brand names. On paper, it looks like a choice between tradition and innovation. Established reliability versus cutting-edge disruption. But here's where it gets more interesting. These surface features reveal less about the real battle than you might think. Let's talk about what makes each side look strong. Japanese automakers have an infrastructure advantage that's hard to overstate. Decades of investment in dealership networks, service centers, and supply chains across Southeast Asia. If your Toyota breaks down in rural Thailand, you can find parts and mechanics. That peace of mind matters in markets where vehicle ownership is still a major household investment. Toyota's market share in Thailand alone is over 30%. That's the power of trust and infrastructure. Now flip to the Chinese advantage. Price. BYD's electric vehicles undercut Japanese hybrids by 30 to 40% in key markets. For a young professional in Jakarta or Manila, that price gap is the difference between owning a car now or waiting 5 more years. Chinese automakers are also moving faster. They're building local assembly plants in Thailand and Indonesia, cutting import costs and gaining tariff advantages. Speed and affordability are powerful weapons in emerging markets. So on the surface, Japan has trust, China has price. Both look strong, but this is where the story starts to get more complicated. Here's what most people don't see. Japanese hybrids carry a hidden cost, complexity. Hybrid powertrains combine internal combustion engines with electric motors and batteries. That means more components, more potential failure points, and higher maintenance costs over time. In developed markets, that's manageable. In Southeast Asia, where road conditions are rough and driving patterns are unpredictable, that complexity becomes a real risk. Customers might trust the brand, but the technology is demanding. Now the Chinese side. The trade-off here is less obvious, but just as real. Chinese EVs are simpler mechanically, fewer moving parts than hybrids, lower maintenance in theory. But there's a quality perception gap. Resale values for Chinese brands in Southeast Asia are still 20 to 30% lower than Japanese equivalents. Why? Uncertainty. Will the brand still be here in 5 years? Will I be able to get parts? Will the battery degrade faster than promised? And here's the big one, charging infrastructure. Chinese EVs are betting on a future where charging stations are everywhere. But in rural Indonesia, the Philippines, and Vietnam, that infrastructure doesn't exist yet. Japanese hybrids don't need it. That's the hidden trade-off. Complexity versus uncertainty. Both sides are gambling on different risks. Let's introduce the first judgment axis, speed versus trust. If you value speed to market and rapid adaptation, the Chinese approach wins. BYD went from zero presence in Thailand to building a full production plant in under 2 years. They're launching new models every 6 months, adjusting to local preferences faster than Japanese automakers can run a board meeting. That agility is powerful in a fast-changing market. But if you value long-term trust and stability, the Japanese approach wins. Toyota isn't going anywhere. Their dealership in Bangkok will still be there in 20 years. Their resale values hold. Their parts are available. For a family buying a car as a 10-year investment, that trust is worth more than a lower sticker price. Here's the insight. This axis isn't about better or worse. It's about what you're optimizing for. Speed gives you early mover advantage and lower prices now. Trust gives you stability and lower total cost of ownership over time. And here's the critical part. Different customer segments in Southeast Asia are optimizing for different things. Urban millennials in Manila want speed. Rural families in northern Thailand want trust. The market isn't uniform. That's why both strategies can coexist, but not in the same customer segments. Now the second axis, upfront price versus total cost of ownership. This is where the narrative completely flips depending on your time horizon. Chinese EVs win on sticker price. A BYD Atto 3 in Thailand costs about 30% less than a comparable Toyota hybrid. For a buyer with limited cash and high interest rates on auto loans, that 30% is everything. It's the difference between buying now or not buying at all. But Japanese automakers are betting on a different calculation, total cost of ownership. Yes, the hybrid costs more upfront, but fuel savings, lower maintenance, and higher resale value mean that over 7 to 10 years, the total cost is often lower. Toyota's internal studies show that their hybrids in Southeast Asia retain 60 to 70% of their value after 5 years. Chinese EVs, closer to 40%. That's a massive gap. So here's the insight. If you're a cash-constrained buyer with a short time horizon, the Chinese EV is the rational choice. If you're a middle-class family planning to keep the car for a decade, the Japanese hybrid is the rational choice. The market looks irrational until you realize different customers are solving different problems. That's the power of understanding judgment axis. The question isn't which is better. The question is, better for whom? Over what time period? Under what conditions? So who is each strategy for? Let's get specific. Chinese EVs are winning in Tier 1 urban centers. Bangkok, Jakarta, Ho Chi Minh City, Manila. These are markets with younger buyers, growing charging infrastructure, and strong demand for tech features. If you're a 30-year-old professional living in central Bangkok, you probably park in a condo with a charging point, you drive mostly in the city, and you care about smartphone integration and software updates. The Chinese EV is built for you. It's cheaper, it's modern, and it works in your environment. Now Japanese hybrids. They're dominating in Tier 2 and Tier 3 markets and rural areas. Northern Thailand, rural Indonesia, provincial Philippines. These are markets where infrastructure is limited, long-distance driving is common, and vehicle reliability over 10+ years is critical. If you're a family in Chiang Mai running a small business, you need a vehicle that works everywhere, doesn't depend on charging stations, and will still have value when you sell it in 2032. The Japanese hybrid is built for you. Here's the insight. Both strategies will succeed, but in different segments. The battle isn't winner takes all. It's a segmentation war. Chinese automakers will dominate urban, tech-forward buyers. Japanese automakers will hold rural, reliability-focused buyers. The question is, which segment grows faster over the next 5 years? Here's the conclusion. This battle won't be decided by one winner. It will be decided by segmentation and time. Japanese automakers will continue to dominate total market share through 2027 because of their rural and family buyer strength. But Chinese EV makers will capture the fastest-growing urban segment, and that's where the momentum is. The real question is, which segment defines the future? If Southeast Asia urbanizes rapidly and charging infrastructure expands faster than expected, Chinese automakers win the long game. If infrastructure development lags and rural markets stay dominant, Japanese automakers hold their lead. The smartest way to read this battle is not to ask who's winning overall. It's to ask, Which segments are growing? Which strategies fit those segments? And where is momentum shifting? That's how you see the future before it's obvious. If this kind of framework helps you make sense of complex strategic battles, subscribe to this channel. We're breaking down the next wave of Asia's economic shifts every single day, and the next one is already forming. Thanks for watching. I'll see you in the next video.